is global now core? That is the domain of today's guest, whom we have identified as one of our great investors. Dennis Stotman is not a household name, but as lead portfolio manager of BlackRock's Global Allocation Fund since its launch 20 years ago, he and his team have delivered a track record that deserves your attention. Take a look at this chart. Over the past 20 years, this broadly diversified, go anywhere in the world, invest in just about anything fund has outperformed more than 20 benchmarks, including multiple domestic and international asset classes. And here's the clincher. It's done so with less volatility than its peer group and equities. I asked Stotman to explain how he did it.
First of all, we're always thinking not only about how we might make money, but also where we might lose money. So we're always thinking about limiting risk. Our main tools to limit risk are diversification and a value orientation. That means we're sensitive to price. We don't tend to own things that could come down a whole lot. Then looking at the return side, if we've done that value part well, it's not only going to help us with the risk side, it's also going to mean that we own some securities that might go up a great deal if we have patience.
You're watching some pretty major trends now that you think are going to that are affecting the way you're investing now and are certainly going to affect the way you invest in the future.
I'll mention three of them. First, we think as you look across the world that market capitalizations are going to look increasingly like GDP. So the relative size of markets will look more like the relative size of GDP, and that means on a relative basis, emerging markets are going to get bigger and look more like their relative GDP, and the developed markets are going to tend to get smaller relative to those developing markets.
Now, can I interrupt you for one second? Because I saw a chart recently that showed the market capitalization of China versus Japan, and the fact that just recently the market capitalization of China surpassed that of Japan, whereas 3 years ago Japan's market cap was 12 times that of China's. So that's the kind of thing that you're talking about,
That's
right?
the type of effect that we're talking about. And it's obviously already in progress.
Right.
But I think that's going to carry on because we expect economic growth to be stronger in the developing economies than in the developed economies for a whole variety of reasons, just touching on two of them. That's where the excess saving and excess financial resources are, and that's where the unmet needs of the populations are. And that ties into a second theme, which is resource competition. We're going to see a lot more resources, especially energy, demanded by the developing economies as they come to be increasingly consumer economies. For example, auto sales in China for the past 8 months have surpassed auto sales in the U.S. Well, those Chinese auto sales are primarily additions to the worldwide fleet, not replacements, and that's much more gasoline that's going to be demanded by China and by the world. There's going to be resource competition, and we think that's going to mean higher commodity prices. Another thing to think about is the value of the dollar. The dollar has ceased to be, in our view, a reliable store of value. It's lost a good deal of its purchasing power compared to other currencies. It has lost its purchasing power to some degree compared to assets. And we've seen that the Federal Reserve is willing to hold interest rates very, very low, thereby not rewarding savers of dollars. We've seen the federal government is willing to run very large deficits, calling into question what long-term interest rates might be in the future. So we believe investors need diversification across a number of currencies and a number of geographies with their investments.